Welcome to Unleashed. Unleashed is produced by Umbrex. You can find us at umbrex.com, umbrex.com. I'm your host, Will Bachman, and I am excited to be here today with Greg Fincke, who is a managing director at Equiteq. He's the co-head of their Americas. Greg, welcome to the show.
Hey, Will, thanks for having me.
So
Great to be here.
I have been looking forward to this episode, this discussion for a long time, and I'm glad we finally managed to schedule it. Tell us first, just give us a quick snapshot of what is Equiteq.
Yeah, so Equiteq is a global sector-focused investment bank. Really, what that means is we work with entrepreneurs in the consulting and IT services space that are looking to create an exit, whether it's through private equity or strategics, and we advise on those transactions. We're a global business, so we have offices London, Singapore, New York, and elsewhere around the world.
What's the typical size of consulting firm that you would help to sell?
Yeah, so typically our clients are in the 3 to 25 million of EBITDA range. We've seen that move around at times, and but no real hard and fast, but that's typically our range.
So 3 million of EBITDA to 25 million of EBITDA. Okay, in that range. And what's it typically translate to revenue? I guess some firms are more, have better margins than others, but what's sort of the typical revenue size?
Yeah, typically low teens of revenue up into just over 100 million, 100 to 200 million of top line.
Okay, cool. And you said you're global. Roughly how many, can you give us a sense of size of your firm in terms of maybe number of employees or firm members or number of deals that you do every year or total deal value size or something?
Yeah, happy to. So we're about 70 people globally.
Whoa.
New York and London are our two biggest offices, followed by Singapore. And then we have smaller outposts, so Boston, Paris, Sydney as well. We did just about 20 transactions last year with an aggregate value of about $1 billion. And that's a good year for us. And we're happy with those types of numbers. We don't need to be doubling that to make our business work. So that's kind of a good steady state for us.
Okay, so here is the money question. Here's the gold question that I think I want to know and a lot of listeners probably want to know is what does it take to get so how do you value a consulting firm / what, and I want to explore in this episode, what are some things that a leader or founder of a consulting firm should do long term if she wants to, eventually sell this practice, whatever, 2, 5, 10 years from now, just be thinking ahead, like, what is sort of a sellable consulting firm? So I'll let you take that, start anywhere you want in that kind of general set of questions.
So one of the reasons we have, I wouldn't call it a floor, but we play in the space. The size range we do is, below 10 million. There tends to be a lot of concentrated key person risk, and that creates a real challenge for a buyer looking to, put down acquisition dollars because it seems risky, and they're looking at a buy versus build, and if the equation starts getting very expensive for the buy, they feel like they could maybe find that person or similar person and hire them much more cost efficiently. It gets hard to get a transaction done. So I think, and that leads to one of the risk factors is key person risk. So when we're looking at building value, it's about having multiple people that can drive the business forward. Another component of that, we have clients that are much larger that have this problem, but also client concentration. So having a diversified client base at some scale, starts making the numbers get larger in terms of total revenue. Every buyer's been burned by a client that had been with a firm for 15 years, and then as soon as the deal gets done, goes away, and it's a significant part of the revenue. So there's a lot of horror stories there. So it's something the investor community is very, very aware of, and it plays into valuation and transactability. So you kind of cross some of those initial hurdles, and you're looking at valuing a business. And even though the multiples aren't based off of gross margin is a natural place to look when trying to understand value. So really, what gross margin is, assuming utilization is in line, 70s on a normalized basis, 70% on a normalized basis. It's really how much extra can you charge the clients for what you do, and that can be through proprietary methodologies, frameworks, IP, but it's the value above just your people's time. And so buyers typically want to see firms in the 40%, and you start getting discounted when you're under 40%. And then once you get in the 50 to 60%, you're sort of at the upper end. Over 60%, buyers and investors kind of have a question as to, is it sustainable? Why is that? It's typically above and beyond where most firms are. So when you're thinking about valuation, you're looking at if you cross those hurdles, how's the business look financially, and then you're looking at what they do, and that's where it's really hard as a sort of to look at the different industry verticals. But you're then looking at multiples and comps, and trying to apply a multiple to the financials.
When you say gross margin for a consulting firm, can you help me understand that math? Because so if the client is paying $100, then minus the gross margin, what's included in that? For example, the partner of the firm might pay out to herself, the full balance of that. So is that kind of profit, or they could be calling that profit margin, or they could be just calling that their own sort of salary / compensation. So it's a little hard for me to understand what we mean by gross margin when the owner is running the firm and taking all the cash that is
Yes.
left over, right?
Yeah. So there's two types of gross margin, if you will. There's a project gross margin, which then rolls up into the corporate gross margin, if you were the company gross margin. So maybe I'll tackle the company gross margin first. So what you would do is take your total revenues for whatever time period, monthly, quarterly, annually, and then below that, subtract out the total delivery costs. Now, what you may be doing, if you want to calculate this post the end of the year, is doing a bit of sort of re-engineering of what a partner cost would be. And what I mean by that is, it's pretty clear if you have people that are just delivering, they're not selling, they're not managing the business, 100% of their costs goes into COGS. So that's subtracted by revenue. Then for partners, what we say is to have a normalized comp, and then divide it up by how much time is spent delivering, selling, managing the business. And then what is over and above that, treat as distributions or dividends. And that would be your EBITDA as well. If you're distributing out 100%, that piece is your EBITDA, which if you ever go to sell, you have dollars you can point to say, yes, I would give that up in a transaction if I'm getting a multiple on that. So maybe I'll pause there and answer any questions, if that makes sense, Will.
Yeah, that's helpful. What are typical multiples for consulting firms? How do you base it off of revenue or EBITDA or gross margin, or
Yeah, it's typically revenue or EBITDA, and different buyers do it differently. I would say in this market, we're seeing revenue multiples typically in the 2 to 3 times range. Again, depending on what you do in end market and things like that, it can vary. And then on an EBITDA multiple, 9 to 12 times EBITDA. And again, some of those numbers move depending on the financial profile of the business, but those are good guide rails.
Okay. So we said one thing that you'd look at is the company really needs to have built up not just one person who's bringing in all the business and the rainmaker, like the founder, but you want to have a firm where there's going to be a repeatable business development process with people that have been, more than one person is, doing client development successfully. And you can imagine other people being trained up in that process. And there's kind of a marketing engine happening where it's not just the relationships of the founder.
Yeah, that's right. And I think the hardest part of growing and building a consulting firm, unlike other industries, is it's sort of equally hard to scale the supply and the demand side of the equation. So demand, acquiring new clients, really selling your services, in parallel balancing creating new consultants, onboarding consultants, teaching consultants how to do things the way your firm has codified them, and getting that balance right, and having the sort of playbook, if you will, but also having delivered on, yes, we can scale both the supply and demand side of our service offering. And that's really what gets buyers excited, because they're typically looking to fill a gap in some part of their service delivery. So if they see, yes, you've checked that box and you have something that can scale within my organization, I'm willing to pay a premium for that.
Now, I'm guessing here, let me state this and tell me if I'm right or wrong, that a buyer would probably prefer a firm, even if it's not just a single founder who's doing the business development. If they had a choice, and choice A is there's 2 or 3 or 4 or 5 principals who are out there kind of doing cold outreach or calling people or networking or relationships or conferences and meeting people to bring some, in clients, versus that would be, option A. Option B is the firm has built up some kind of reputation and some kind of name brand such that it's just getting like inbound leads on the website, right? Because they have some kind of, good web traffic. They have some kind of reputation out there. You'd probably prefer option B, where it's not so dependent on human labor, but you've got that market niche identified, right?
Yeah, I think that's right, on balance. So yeah, I think a lot can be, growing the sales side doesn't have to mean bringing in expensive people to just go out in the market and look for opportunities. It can be, really done through marketing and brand building, and making sure that you're able to capture that into services revenue.
To what degree would you be looking at sort of unique systems or technology, or having built up some sort of unique capability? How much of a factor would that be?
Yeah, it certainly is. I mean, we look at, when we're working with our clients, we look at IP as a very important part of every consulting IT services business, and it could be IP to deliver your business, IP to win business, or IP to run your business. And really, what we're looking for is to demonstrate that IP gives them an edge, and that could be, through retention, right? They have super low retention. They've built an IP that, some IP around how to, manage their people and interact with their people, right? So that, like, you can be creative with it, but also, they have better margins because their IP allows them, to be more profitable, or, allows them to sell more. So they're growing at a rate. I think where IP it is most powerful is when it can be tied to revenue, but you can be pretty creative in sort of showing how your IP and your frameworks, methodologies drive value, and be able to quantify that.
And then what about on the kind of people side, the recruiting process, method, engine? To what degree is that something that you're going to look at and evaluate?
Yeah, it absolutely is. I mean, I especially the last 2 years when talent was really really scarce, and in a lot of areas it still is. And what we talk to our clients about is the ability to take a recent college graduate and make them productive, but not just stop there. Have the framework and the career progression model that they can move all the way up to the highest partner level or principal level, whatever it may be, and really become go from being able to deliver on projects to deliver on revenue. And if you can sort of put that whole career plan in place and have, competency frameworks and coaching and training to help people advance, that becomes seen as very valuable because it really allows you to control your ability to scale and not be reliant on having to go through recruiters and into the market to pull people out, which can be unpredictable and expensive.
So if you can grow your own engagement managers and associate principals and principals, that's much better than if you're dependent on finding and hiring those people from the
Yeah,
marketplace.
yeah, and yes, 100%. Because if McKinsey, if you're taking people out of McKinsey and they increase comp, 50K, well, now that directly impacts your ability to go higher at that level versus coming out of college recruited. Even though those jobs may be out there, they tend to be more loyal, tends to be predictable, and you have better control over costs.
I think that I've seen at one point an Equiteq framework over like firm valuation. It was a few years ago I saw that.
Yeah.
Do we miss any of those elements that you consider when you're doing the valuation?
Um, you know, I think the management quality is one that I think we rate pretty highly, and that's about how well the business is run and sort of the reporting, not whether not whether you're a good manager or not. But that actually becomes pretty important for a lot of buyers. We talked a little bit about people, but retention is a really important one as well. Uh, you know, taught taught we touched on sales and profit growth. One other piece maybe where we haven't dialed in on is who your clients are and how you engage with them. So, Fortune 500 and private equity and their portfolio companies are kind of the two most valuable end markets. And then there's vertical specialization, and that is something else. But going after companies that can have big wallet spend are the sort of best two end markets from a value perspective. And then from a delivery model, being able to deliver fixed fee on margin with good margins is most desirable. T&M is generally okay, but it can be a little easier for to get squeezed on margin. And then the one that's the most lucrative for owners, but seen as for owners today, but seen as risky for investors, is a gain share model, where you're taking a percentage of savings or some other financial outcome. That's seen as the riskiest. So, for us, having either fixed fee or T&M, and working with large corporates or private equity is an important value driver as well.
Beyond corporates and private equity, walk down the chain a little bit more for me. What are sort of like the middling kind of options, like and what are kind of the crummiest options in terms of client and markets?
Yeah, so I mean, it really comes down to their ability to spend money on consulting. So, the maybe 500 million and up is probably the third in the list. And again, those would be 500 million that don't have private equity investors. They're just they're standalones. Below that, what we see is that people may engage on a consulting projects on very much one-off engagements, and they may go away for a few years, so they're not spending sort of consistent dollars in consulting, and that's why they're seen as less valuable. Is that you got to break into these companies over and over again, and it's harder to sell on work. It's not that they're bad companies; it's just their financial spend is significantly lower.
Who are typically buying these consulting firms? So out of the 20 that you helped broker deals last year, what's the typical buyers?
Yeah, so it's been changing. So 5 years ago, it was about 25% of buyers in our space were private equity, 75% were strategics. It's now 50-50. So private equities come into this space a much more meaningful way than they've ever had prior. And so that does two things. It creates new platforms that they're investing in, and then their platforms are acquiring bolt-on acquisitions. So we've really seen a lot of growth from private equities looking for platforms, and their platforms looking to make acquisitions. And the other, in the strategic side, it's a big range for our clients. I mean, Accenture is kind of the 800-pound gorilla in the room in a sense, in that they spend about $2 to $3 billion a year on M&A on consulting firms, and that is they are the number one acquirer of businesses in the world by number of acquisitions. So they are just a major player in this space. But even EY, they've split off their consulting and business from accounting, and the consulting firm has said they're going to spend $2.5 billion on M&A. Then you have the IT outsourcers, you have other consulting firms, and then you have some of the marketing services firms. So it's actually a very robust market from options in terms of different strategics, private equity, and private equity platforms.
So Accenture is the number one acquirer in the world by number of acquisitions. That's amazing. Like how many do they do? I guess they're doing a lot of these, buying
Yeah,
up these small
I think
shops.
it's north of 60 a year.
Wow.
Yeah,
And
they have full teams set up globally. Corporate, I mean, their corporate development function is very mature, and yeah, it's a core part of their growth.
what sort of firms do they acquire?
I'll just give an example just to highlight the range of some of the things we've sold them. We sold them a ServiceNow consulting firm focused in Western Canada, and they had a thesis around ServiceNow and expanding in Canada. We also sold them a company called HRC, which is a retail specialist consulting firm, a very niche boutique, and they bought that one as well. And we sold them Myrtle Consulting, which is larger operational consulting, manufacturing. So they saw one of their big theses is on so next generation of industry and connectivity, and these guys were doing some operational strategy work within large manufacturing companies. So it's really a range from IT, operational consulting, strategy consulting, and and everything in between, if you will.
What should a owner of a firm, or if it's partners expect if they sell their firm? What's the typical kind of earnout period? How long do they have to stay on, and so forth?
Yeah, it's a great question, Will, and it's the hardest one to handicap going into a transaction. So what we tell our clients is be prepared for 60-40. So when we're talking valuation, be prepared for 60% cash at close and 40% in an earnout up to 3 years. The reality is it could be anywhere from 60 to 100%, but most likely it'll be in the 60 to 80% cash at close, with 40 to 20% in a earnout of some form, typically 2 to 3 years. And those earnouts vary significantly by what the acquirers are comfortable with. which is why in a competitive process, having options and being able to compare is important. Some will have it on revenue, some will have it on gross margin, some will have it on EBITDA, some on retention, and others a mix, some combination of one of those four. So it's a real range on what goes into an earnout.
How should founders think about what's going to happen to their teams if they, if they sell their firms, in terms of teams, you had this culture where it's a small boutique firm and now it's getting acquired by one of the major global firms. What do you see typically happening to the teams that stay behind?
Yeah. So, a lot of our clients have stayed, and, a couple things happen. And, I sold a company to a very large strategic, if you will. And I had one of the management, one of the members of the management who had a very small piece of equity reach out and say, I want to do what those founders did in 5-7 years. I'm going to call you up. So one thing I think, and we've seen it, we had another company, they went through a transaction, they were right below the equity line. They started their firm and sold it and did incredibly well. So one thing I think a transaction does is it will inspire some group to want to be entrepreneurs and say, wow, that was really cool. Like I saw, what so-and-so built and had an exit. I want to do that. So that's one thing we see and I've heard a lot of stories about. But mostly it's about the integration plan and why they are buying the business. So, it breaks down into really one of two. There are probably other reasons, but two primary reasons. One is they want a new service line. So you're doing something tangential to what they already do. The belief is if they acquired this capability, there'd be synergies, and the two service lines together would create more value than just having one and not the other. So in that scenario, the team stays pretty independent. There's nothing really to integrate it into in terms of delivery. There's probably a little bit of administrative. There certainly would be administrative changes and systems and things like that. But the buyers generally in that scenario are not looking to disrupt the team because it's very separate from their other service lines. In the case where they have that service line, they're looking to add scale. That is much more of a bespoke integration where the management team really teams have to work together to design how those people are going to be integrated, and that could be more of a challenge potentially for junior folks being brought in with another existing team. I don't think we've seen it have worse results, but I think it is more of a challenge than if the acquisition's a new service line.
I imagine that you keep in touch with some of the founders who you help them sell their firms after they, do their earnout period. Sure. I'm curious your perspective on over the years what you've seen people do after selling a firm and how satisfied they are with their life after leaving. Maybe they regret it. Maybe they're delighted playing golf or whatever. But what have you seen people do after selling their firm?
So a surprising number have stick with the acquirer post earnout. So they do their earnout and then they stay. And a lot of it is they say, I've already started a company. I don't want to do it again. I had my reward for that. And typically what's happened in these scenarios is the larger company, the acquiring company, has promoted them, offered them, they found a role that they actually really enjoy. And it's a role that they may not have had access to prior to becoming an entrepreneur. So, some of our clients are, managing teams that are 5 times what their team was when they sold, and they're seen as a global expert on the topic, and are flying around, visiting different offices as an internal global expert, and they're like, "This is pretty cool. I've never thought this job existed, and I love it." And so we have a lot of people stick around. We have some folks, just I have a former client that's circumnavigating the world in a catamaran with his family. We have people who have certainly used it as their retirement. We haven't had too many that in our client base sort of go for number two. It's either kind of been either the retirement path or the stay with the company. No one we've heard from has sort of said they regret it, but maybe they're just not talking to me either. So that could be a fair challenge.
So you haven't seen people going out there and saying, "Oh, okay, I'm going to start a new firm now. I did that for 15 years. I have this
Yeah, no, I
other,
had
I have
so
this,
much fun, and yeah, I want to do it again. Yeah,
no."
that's more uncommon. I think unless they have some like great new idea, but a lot of our clients have said, look, I built a consulting, scaled it, sold it. I don't need to do it again, but I'm sure there's someone out there that'll do it.
I imagine, at what stage do you start talking to the partners of firms, and you know, is there cases where you start talking to them when they're really not quite ready and they need 1 or 2 or 3 years to get their firm in the right shape to sell? And what's sort of the kinds of advice that you're giving firms that are at that stage?
Yeah, 100%. We've had companies we've spoken with and started the relationship when they are, um, very small. I think what's important and where we become relevant is having a goal and saying, hey, we're at X size today, but we really want to get to Y and sell and create an event. How should we be thinking about that? So that's where our advice uh, can be more relevant, and then really what we're trying to help them figure out is what are the bottlenecks for growth. And again, making it simple, is it the client acquisition side, or is it um, the talent acquisition side? And typically, one of the things we find that makes a big difference on sort of hitting those initial growth hurdles is a lot of companies open the spectrum of what they do and who they do it for to be incredibly broad, because they don't want to miss anything. And we actually give the opposite advice, and we say be very focused on what service you're going to do for what industry, and and by having that focus, you're going to now you don't have to do that forever, but you're going to start capturing market share, being relevant, and then expanding from there. So that's one of the things we often talk to our clients that are trying to hit some of these growth milestones is really having a focus and a perspective and a target market to go after.
When you see firms that are maybe good on the talent acquisition side and they have decent revenues, but maybe they haven't been growing as strong, what sorts of advice do you give them on client acquisition? How to get better there?
Yeah, that's there's a number of things we look to do. So uh, a lot of companies want to hire sales teams. It's like if I hire a sales team, then I'll solve it. Well, uh, consulting services doesn't lend itself well to a sales team because it's not a product. You're buying expertise, and so the only time a sales teams work if you're able to productize some part of your solution that they could sell. So if that's not the case, is really developing talent to open doors, and a lot of that comes down to marketing. So thought leadership, having a differentiated perspective, and advancing that through the channels to your end customers. So there's no sort of magic bullet on how to solve the sales and marketing. or the new client acquisition. But our advice is you're going to be better off developing your people to learn how to convert clients and investing in marketing than trying to bring on sort of professional salespeople to try and bring in new clients.
For firms that are, I'm curious both on both sides. So for firms that are smaller than you guys deal with, what typically do they do, if anything, if they to sell their practice? And then my second question, once we talk about that, I'm going to ask you about the big, large firms. But for small firms that are less than 3 million of EBITDA, do they have any do they have any pathway? Maybe they're too small for you to really engage with, but do those transactions even happen?
Yeah, they certainly do. And part of why it's hard for us, there's some economic reasons, but also it's a different kind of buyer universe than the Accentures and the larger people that we engage with. So for them, it's unlikely they would buy a 15-person consulting firm or 10-person, 5-person consulting firm. So it's going to be buyers that are sort of less active, smaller buyers that are just looking to tuck in a service line. So the advisor network in that for those types of deals are business brokers that can help. And then the deals certainly can get done, but typically with sort of buyers that are not not as active in M&A, you tend to see deal structures that are not as favorable for sellers because they're a bit more defensive from buyers that are just not as comfortable doing M&A. So it's typically a smaller sort of scale buyer, and it's probably not something they're doing regularly. And your advisor could be your lawyer or a business broker.
What do these PE firms do with consulting firms? I'm unfamiliar with that world. Like, so maybe you can give me an example, or just tell me how do they typically run these things, and then I'm just like a standard portfolio company. They invest, grow, and then try to flip it in 5 years.
Yeah, exactly. I mean, one maybe you and some of your listeners might know is Stacks, which does commercial due diligence for private equity firms.
Yeah.
And they were acquired by Bluepoint, private equity. We actually were hired to advise Bluepoint. They wanted our expertise on that transaction. And yeah, they're trying to scale it and are scaling it aggressively. New geographies, new service lines. I'm not. I don't know what their exit strategy is, but typically there's a thesis around either the next private equity, so having another change of control, another investor, or a strategic. So yeah, that's certainly one sort of management consulting firm, if you will, strategy consulting firm that took private equity backing. There's another one, IGS out of Boston, does similar work, and they're backed by Interlock, a private equity from LA. So those are two recent deals, and then just for us, we sold a custom application development firm called Aleda to CIVC, and a data analytics consulting firm called Cleartelligence to Align Capital in the last 3 or 4 months. So it's a pretty active market. I would say it is more heavily skewed towards the IT services space, but on the management consulting side, and there have actually been a number of healthcare management consulting firms that have done really well.
And then how did the big deals happen? So you said that you do up to, I think, what we said is like up to maybe 100 million in revenue. Sometimes you talk, like, I don't know, PwC acquires, Booz and Company or something.
Yeah.
Like those big deals, who's typically handling those?
Yeah, so on those billion plus deals, we're not typically involved. Love to be at someday, but Those are done by typically bulge bracket banks, the Morgan Stanleys, the Goldmans of the world. One of the attributes of our market is that there aren't a lot of billion-dollar deals done in this space. It's maybe one a year at most. So it's not a huge volume, and at that upper end, a lot of the deals that are done are between that, call it 50 and 250 million of enterprise value. The industry is very much a barbell shape. There's a lot of smaller companies. There's not a lot in the middle, and there are quite a few, scaled consulting firms.
Interesting. So, for what else should I ask you about this whole space? What are the other kind of intricacies or things that surprise and fascinate you about this space that most people who are consultants would not know?
Yeah, I mean, I think what is always enjoyable, I guess, for me and working with our clients is really exploring the range of options that are out there. I mean, I think it's it is a massive marketplace, and there are a lot of strategic and private equity options that when you do something creative, it can really unlock significant opportunities and value. So, I think as people are thinking about an exit, we did speak about Accenture and EY, but there are a lot of other companies out there that are looking to grow through M&A, and it makes sense because these businesses are hard to grow organically, right? And so if you figured out a way to deliver a unique service and scale it, you're building something very valuable. So it's and it doesn't have to just be one of the large strategics that would where you'd end up.
How do you and your firm do, business development and build the level of trust with a set of partners that they're willing to entrust your firm with the sale of their firm?
Yeah, so I mean, I like to think we do a pretty good job of staying focused and trying to deliver free insights to the market through our reports and content we put out. So one of the things we take very seriously is we stay laser focused on one sector. So everyone on our team, from our analysts up to managing directors, are only doing really one type of transaction, which we think is important. And then we have a perspective, and I don't think I'm giving anything away, that we like to give advice to our clients around building value both internally. So what can you do in your firm to build value, and then provide that external perspective on the market. And our view is if we can do that and we're likable, people like working with us, the work will come. So it's at the end of the day, a very rewarding job working with clients over multiple years to get their business to the right place, and then see that economic return and reward for all the hard work they put into building their business.
I imagine that the universe of these firms is small enough that you've probably identified most of those firms that are in that 3 to 25 kind of million EBITDA type thing. I mean, they're identifiable, right?
They are, but in the U.S. alone, there's probably about 1,000.
Is that right?
Yeah, and in IT services and management consulting.
Wow. That is pretty amazing that there are 1,000 consulting firms. That's.
I mean, it's just at that size, and just in North America, and I think that's one of the fun parts about this market. There are, I mean, I'm surprised on a. It seems like a weekly basis. I'll meet a consulting company. They'll be much bigger than I thought, and I've never heard of what they did before.
Wow.
And I'm like, how are you? Like, how I spend my entire day with consulting firms every day, and I'm still surprised. So there's a lot of really cool firms out there.
1,000 firms. So does your firm kind of try to keep tabs on all 1,000 and just, keep track of the founders and touch base with them periodically? And that's a lot of firms.
Yeah, we do. I mean, we certainly have our distribution lists, and we try and share insights when asked. But we certainly don't have personal relationships with all those firms. So our team, we have a few. We're not huge, but we have a few people in the organization. Their role is coverage, and their day job is to speak with owners, private equity firms, and strategics, and just know the market, know what's happening, because it is so big. We can't kind of just cover it haphazardly.
All right. So few questions around media diet. What do you, in terms of what do you read to stay on top of the consulting industry? Any newsletters, websites, anything that you typically follow to stay on top of the news?
So there's a couple good ones. E2E is it has all, like, you can find every SAP transaction, I think it's called Channel E2E is the website. And you can look by every acquisition Cognizant's made, every acquisition, different spaces. So it's a broader sort of free data source, but it has good sort of lists of deals in particular spaces. So that's a good one. And then I think it's consultancy.com, consultancy.uk, maybe lists every recent transaction. And they'll highlight, like, it's broader than the UK. I think you can go to consultancy.uk, you can then switch to a different country, but that's like consulting.us is what it is. So yeah, they'll have all different news reports, but also every deal in this space that happens, they'll put a little blurb up. So those are two good sort of free websites you could use.
How about podcasts? Any podcasts that you follow on the consulting world?
So one resource I use is Collective 54, which is a network of consulting owners, and Greg Alexander, who runs that, does a podcast that I'll listen to from time to time.
All right. How about any books? Any books? Favorite books on the consulting world?
Oh man, I don't know if they would be pure consulting. We have. I'm just looking at my library because I get handed these books all the time. Not off the top of my head. I'd have to look. There are some really good ones out there, but yeah, not off the top of my head.
Yeah, I don't know any books on the current state of the consulting world, but certainly the world's newest profession is a pretty good one by Chris McKenna about the history of consulting, and he's a McKinsey alum and a professor in the UK, and he wrote about the rise of the management consulting industry. And then there's another one, The Lords of Strategy, which is pretty good about kind of the rise of strategy as a piece, which I wasn't really aware of. But like the consulting firms didn't really start as strategy firms. McKinsey was not really a strategy firm when they started, and so The Lords of Strategy is pretty interesting about Bain, BCG, and then how McKinsey moved away from like org design and productivity type stuff to more strategy.
So the one I mentioned Greg Alexander, but he wrote a book called The Boutique, which is pretty good as well.
Okay. Cool. So if listeners are intrigued and they want to make sure they get your newsletters and reports and maybe follow up, where would you point them online to learn more about Equiteq?
Equiteq.com. Just sign up and we'll make sure you get all our content and thought leadership.
Okay. And I will put that link into the show notes, but just to help listeners who aren't looking at the show notes, how do you spell that for us?
Yeah. EQUITEQ.com.
All right. We will include that link in the show notes. Greg, this was a fantastic discussion. Thanks for helping enlighten me about how to value consulting firms, and how to think about selling your firm someday. Maybe one of our listeners will become a client of yours, and you'll help them with an exit. It's been great speaking with you.
Yeah, thanks so much, Will. Really enjoyed it. Take care.